Picture this. It is Wednesday morning, and the smoke is finally beginning to clear. If you are watching this right now, I need you to understand something. What happened over the past few weeks was not an accident. It was not random market volatility. It was not the invisible hand of supply and demand working its natural magic. What we witnessed was a calculated demolition of price, a systematic flushing of weak hands, and a transfer of wealth so brazen that it would make a pickpocket blush. Silver crashed to $67 per ounce. The headlines screamed panic. The mainstream financial media declared the bull market dead. Retail traders liquidated their positions in terror, watching months of gains evaporate in a matter of days. But here is what those headlines did not tell you. Here is what the talking heads on financial television conveniently forgot to mention. While the price was collapsing on your screen, something very different was happening behind the curtain. The smart money was not selling. They were buying. They were backing up the trucks and loading up on physical metal at prices they had not seen in months. And now, as I record this for you today, silver is rebounding. It is climbing back from those $67 lows with a vengeance. And the same institutions that pushed the price down are now scrambling to reposition themselves for what comes next. Welcome back to Mr. Ag. I am your host, and today we are going to dissect this entire situation piece by piece. We are going to look at the mechanics of the crash, the geopolitical chess moves happening behind the scenes, and most importantly, where this market is headed next. Because if you understand what I am about to show you, you will realize that the $67 bottom was not the end of something. It was the beginning. Before we dive into the wreckage, I need to know where you are watching from today. Are you monitoring the charts from a trading desk in Singapore? Are you checking your phone during lunch break in London? Maybe you are an early riser on the west coast of America, coffee in hand, trying to make sense of what just happened to your portfolio. Drop your location in the comments below. I want to build a map of our global community because what we are witnessing is not just a silver story. It is a story about the entire global financial system, and people from every corner of the planet are starting to wake up to it. Let us peel back the layers of this market and examine the anatomy of the crash. What happened to silver was not a single event. It was a convergence of three specific forces, three pressure points that were squeezed simultaneously to create maximum damage. If you understand these three factors, you will never look at a price chart the same way again. The first factor is the dollar deception. You have heard the basic narrative. The US dollar weakened, and this helped precious metals find support. That is true as far as it goes, but it is like saying a house burned down because there was fire. It tells you nothing about who lit the match. The US dollar index has been forming a pattern that the technical analysts call a descending structure. It appears to be setting up for another move lower, potentially breaking below the 95 level. But here is what the mainstream reports are not explaining. This dollar weakness is not happening by accident. There are whispers, credible whispers, that Chinese banks may be slowing their purchases of US Treasury bonds. Think about that for a moment. The largest foreign holder of American debt may be stepping back from the table. This is not just a currency story, this is a geopolitical signal flare. When China reduces its appetite for US bonds, it sends a message to every central bank on the planet. It says the dollar's position as the unquestioned reserve currency is no longer guaranteed. And when that message spreads, capital begins to look for alternatives. It looks for assets that cannot be printed, that cannot be sanctioned, that cannot be frozen in a bank account with the stroke of a bureaucrat's pen. It looks for gold. It looks for silver. The dollar weakness that supported the precious metals rebound was not random volatility. It was the early tremor of a tectonic shift in global finance. The second factor is the political powder keg. We are living through one of the most geopolitically tense periods in modern history, and the next few weeks could determine the trajectory of global markets for years to come. According to unofficial reports, Donald Trump is expected to visit China in early April. This is not a ceremonial handshake photo opportunity. The topics on the table are the kind that start wars: Taiwan, Ukraine, Iran. Each of these regions represents a flashpoint where American and Chinese interests collide. The tensions have been escalating since the start of the year, and the risk of military action, whether direct or by proxy, has risen to levels we have not seen in decades. Now, I want you to think like an institutional investor for a moment. You manage billions of dollars. You have a fiduciary responsibility to protect that capital. And you are watching the leaders of the world's two largest economies prepare to sit down and discuss the future of global order. What do? You hedge. You allocate a portion of your portfolio to assets that perform well during uncertainty. You buy insurance in the form of precious metals. The recent movements we have seen, the grouping of U.S. naval forces near Iran, the warnings related to the U.S. bond market, these are not isolated events. They are positioning moves ahead of negotiations. They are signals of strength or perhaps signals of desperation, depending on how you read them. For silver, this geopolitical backdrop is rocket fuel. If the Trump-China meeting signals easing tensions, risk appetite may improve broadly, but precious metals will hold their gains as investors remain cautious. If the tone is confrontational, if there is any hint of escalation over Taiwan or military action regarding Iran, the safe haven trade will explode. Silver will not just rise, it will surge as capital floods out of risk assets and into the only stores of value that have survived every empire, every war, and every currency collapse in human history. The third factor is the structural starvation. This is the piece that the paper traders consistently ignore, and it is the piece that will ultimately determine where prices go over the next decade. The silver market is in a structural deficit. Let me explain what that means in plain language. Every year, the world consumes more silver than the mines produce. The gap is made up by recycling and by drawing down existing inventories. But there is a limit to how long that can continue. The inventories are not infinite. The London vaults are draining. The COMEX registered category is at historically low levels. The metal is leaving the paper trading system and moving into private storage, into industrial supply chains, into the strategic reserves of nations that understand what is coming. Now think about the demand side. This is not your grandfather's silver market. We are not talking about jewelry and silverware. We are talking about the absolute necessities of 21st century civilization, solar panels. The new generation of solar technology requires significantly more silver per unit than the panels of just 5 years ago. And the global push for green energy is not slowing down. It is accelerating. China is covering its deserts with solar farms. Europe is mandating solar installations on rooftops. Every single one of those panels represents silver that is extracted from the earth and locked away for 20 or 30 years. It is not coming back to the market. It is gone. Artificial intelligence. The data centers powering the AI revolution require massive amounts of high-performance electrical components. Silver is the most conductive element on the periodic table. You cannot substitute it with copper and expect the same performance. The servers that run the algorithms, the chips that process the data, they depend on silver. Military applications. A single Tomahawk cruise missile contains approximately 15 kilograms of silver in its guidance systems and electronics. When that missile is launched, the silver does not return to the vault. It vaporizes. It is destroyed. And in a world of rising geopolitical tensions, defense contractors are not reducing their orders. They are stockpiling. They are securing supply chains. So we have a market where demand is driven by government mandates, energy transition, and military necessity. These are price-insensitive buyers. They do not care if silver is $67 or $97. They need the metal. And on the supply side, we have mines that are depleting or grades that are falling, and a production profile that cannot respond quickly to higher prices because most silver is produced as a byproduct of other metals. This is the fundamental reality that the paper price crash tried to obscure. But you cannot change physics with a futures contract. You cannot create silver with a keystroke. And eventually, the physical reality asserts itself over the paper fantasy. Now let us talk about what happened at the bottom. When silver touched $67, the headlines were apocalyptic. The forums were filled with despair. Traders who had bought at higher levels were forced to sell as margin calls came in. It looked like a bloodbath, and in many ways it was. But here's the question that the mainstream media never asks. Who was buying? Someone was on the other side of every sell order. Every share that was liquidated in panic was purchased by someone else. If you look at the volume data, if you examine the order book structure during those chaotic sessions, you will find something interesting. There were massive limit buy orders sitting deep in the order book, waiting to catch the falling knives. These were not retail traders trying to catch a bounce. These were institutional orders, programmed to accumulate at specific price levels. The commercial entities, the bullion banks, the players who had been holding short positions for months, they used the panic to cover. They bought back their shorts at a discount. They shifted their books from net short to neutral, or perhaps even net long. While the average investor was selling at the absolute bottom, the smart money was filling their baskets. This is not speculation. This is how markets work. Volatility is not a bug in the system. It is a feature. It is the mechanism by which wealth is transferred from the impatient to the patient, from the leveraged to the capitalized, from the uninformed to the informed. The $67 crash was not a defeat for silver. It was a shakeout. It was a stress test designed to separate the tourists from the residents. And now that the tourists have left, the real move can begin. Let me show you the technical picture because the charts are telling a story that confirms everything I have just described. Silver is currently trading in what technical analysts call a contracting triangle formation. On one side, you have a downward trend line connecting the highs from the January peak near $108. On the other side, you have an upward trend line connecting the lows, including the recent $67 bottom. These two lines are converging, squeezing price into a tighter and tighter range. This pattern is significant because it represents a coiling of energy. The buyers and sellers are in equilibrium, but that equilibrium cannot last forever. Eventually, price will break out of the triangle, and when it does, the move will be violent. The key level to watch on the upside is $90. This was the zone from which the recent sharp sell-off began. It is a psychological round number, and more importantly, it is a technical resistance level where previous buyers became trapped. If silver can break above $90 with conviction, with high volume, the next target opens up immediately. We are looking at a potential run toward $100 and possibly beyond. On the downside, the level I am watching is $80. This is the near-term support that needs to hold if the bullish structure is to remain intact. As long as silver stays above 80, the buyers are in control. The 50-period moving average is sitting near $84, and the 100-period moving average is providing support around 80. These moving averages act like a floor, catching price on pullbacks and launching it higher. A decisive break below 80 would change the picture. It would suggest that the selling pressure is not finished, and we might need to retest the $67 lows before the next leg higher can begin. But as of right now, the evidence suggests that the bottom is in. The structure is bullish, the triangle is coiling, and the breakout, when it comes, will catch many traders by surprise. Let us zoom out and look at the broader precious metals complex, because silver does not trade in isolation. Gold moved back above $5,000 per ounce last week. That is a psychological milestone that changes the conversation entirely. When gold is above 5,000, it signals to the world that something fundamental has shifted. It validates the thesis that fiat currencies are losing purchasing power, that central banks cannot be trusted to maintain the value of money, that real assets are the only refuge. The gold move was triggered in part by weak U.S. retail sales data. The December reading came in flat, 0% growth, missing the expected increase of 0.4%. This matters because it suggests the U.S. consumer is running out of steam. The economy that was supposed to be resilient, the soft landing that was supposed to justify keeping interest rates elevated, it is showing cracks. The markets are now pricing in a higher probability of multiple interest rate cuts in 2026. When rates fall, the opportunity cost of holding non-yielding assets like gold and silver decreases. Money flows out of bonds and into metals. But there is another layer to this story, and it involves the Federal Reserve itself. There are reports that President Trump has been frustrated with his Fed chair nominee, Kevin Warsh. There is speculation about possible political pressure on the Federal Reserve to lower rates more aggressively than the economic data would justify. Fed Governor Stephen Miran recently made a remarkable statement. He said that a central bank can never be fully independent from politics. Think about the implications of that statement. The fiction that the Fed operates independently, making decisions based purely on economic data, is being openly questioned by a Fed governor. If the central bank is perceived to be a political tool, what happens to confidence in the currency it issues? What happens to foreign demand for U.S. Treasury bonds? What happens to the dollar's status as the world's reserve currency? Gold above 5,000 is not just a number on a chart. It is a vote of no confidence in the monetary system. And silver, with its dual role as both a monetary metal and an industrial commodity, is positioned to outperform in this environment. The gold-to-silver ratio remains historically elevated, meaning silver is undervalued relative to gold. When the ratio corrects, and it always does eventually, silver will move faster and farther than its yellow cousin. Now let us talk about what is coming next, because there is a binary event on the horizon that could trigger the next major move. The delayed non-farm payrolls report is scheduled for release, and the market is holding its breath. If the jobs data comes in weak, it will confirm that the U.S. labor market is softening. It will increase the odds of rate cuts, it will pressure the dollar lower, and it will send gold and silver higher. Some analysts are targeting $5,150 for gold in the immediate aftermath of a weak jobs print. If gold runs to 5,150, silver will not be sitting still. A sympathetic rally in silver could easily push us toward that $90 resistance level I mentioned earlier. And if we break 90 with momentum, the $100 target comes into focus quickly. On the other hand, if the jobs data surprises to the upside, if the labor market shows unexpected strength, we could see a temporary pullback in precious metals. The dollar might bounce. Risk appetite might return. Traders might take profits after the recent rally from the lows. But here's the key insight. Even a strong jobs number does not change the structural fundamentals. It does not refill the empty vaults. It does not reduce the industrial demand for silver. It does not resolve the geopolitical tensions. It just creates another opportunity to accumulate at lower prices. The trend is clear. The direction is set. The only question is timing. I want to take a moment to address the historical parallels because we have seen this movie before. The pattern of violent crashes followed by explosive recoveries is not new in the silver market. It is practically a defining characteristic. Cast your mind back to March 2020. When the pandemic hit, silver crashed to $11 per ounce. $11. It looked like the end of the world. Investors were liquidating everything to raise cash. Silver, being liquid and easily sold, was dumped without mercy. But that crash was the greatest buying opportunity of a generation. From that $11 low, silver rocketed to $30 in less than 5 months. A nearly 300% move for anyone who had the courage to buy when everyone else was selling. Or look at 2008 during the financial crisis. Silver crashed from over $20 to under $9. The banking system was on the verge of collapse. It felt like the end of the financial world as we knew it. But again, that crash was followed by a massive bull run that eventually took silver to nearly $50 in 2011. The pattern repeats because the psychology repeats. Human fear creates the crashes. Human greed creates the rallies. And the fundamentals, the actual supply and demand for physical metal, eventually reassert themselves over the paper price manipulation. The $67 crash we just witnessed fits this pattern perfectly. It was a liquidation event, driven by leverage, margin calls, and panic. It shook out the weak hands. It transferred metal from those who could not hold to those who could. And now, with the shakeout complete, the market is free to move higher. We may look back at $67 the same way we look back at $11 in 2020 or $9 in 2008, as a moment of maximum fear that marked the ultimate buying opportunity. Let me lay out the 3 scenarios I am watching for the weeks ahead. I call these Scenario Alpha, Scenario Beta, and Scenario Gamma. You need to internalize these because one of them is playing out right now on your screen. Scenario Alpha is the grind higher. In this scenario, silver slowly and methodically climbs back toward $90. There are pullbacks along the way, days when the price drops 2 or 3% and the bears claim the rally is over. But each pullback is bought. Each dip finds support at higher lows. The moving averages curl upward and begin acting as dynamic support. Volume on up days exceeds volume on down days. This is the most likely scenario based on the current structure. It is also the most frustrating for traders because it happens slowly. There are no fireworks, no vertical candles, no rush of euphoria, just steady, grinding progress toward the target. If you see this pattern developing, the strategy is simple. Hold what you have, add on pullbacks, do not try to trade the chop. Scenario Beta is the explosive breakout. In this scenario, a catalyst event, perhaps weak jobs data, perhaps a geopolitical shock, perhaps a surprise announcement from China or the Fed, triggers a surge of buying that overwhelms the sellers. Price gaps higher, slicing through resistance levels like a hot knife through butter. The short sellers who bet against the rally are forced to cover, adding fuel to the fire. We see a vertical candle on the daily chart, the kind that makes your heart race when you are positioned correctly. In Scenario Beta, silver does not stop at 90. It blows through 91, then 92, then challenges the psychological $100 level before pausing to catch its breath. This is the low probability, high impact outcome. It is what happens when all the bullish factors align at once. If you see this pattern developing, the strategy is to let your winners run. Do not take profits too early. The fear of missing out that kept you sidelined will be replaced by the fear of holding too long. Manage that fear by having a plan in advance. Scenario Gamma is the retest. In this scenario, the rally from $67 loses steam before reaching 90. Sellers step in, perhaps triggered by a stronger dollar or a risk-off event. Price begins to drift lower, testing the $80 support. If 80 holds, we bounce and begin the climb again. If 80 breaks, we are likely heading back toward the $67 lows for a second test. This is the scenario that tests your conviction. It is designed to make you doubt everything you believe about the market. It is designed to shake you out of your position right before the real move begins. If you see this pattern developing, the strategy depends on your risk tolerance. Conservative traders wait on the sidelines until support is confirmed. Aggressive traders use the retest as a second entry opportunity, adding to positions at lower prices. The key is to have a plan before the scenario unfolds. Decide in advance how you will respond to each possibility. Do not make emotional decisions in the heat of the moment. Now let me speak directly to the different types of people watching this. If you are holding physical silver, your strategy is the simplest of all. Do nothing. You do not own paper promises, you own the metal itself. The weight of the coin in your hand did not change when the price crashed to 67. 1 ounce is still 1 ounce. It will still be 1 ounce a year from now, a decade from now, a century from now. The chaos on the screen is just noise. It is a distraction designed to make you doubt your position. Turn off the charts. Stop checking the spot price every hour. You are not trading. You are accumulating. You are building a position for the long term. The price will fluctuate. There will be crashes and rallies, fear and greed, headlines predicting doom and headlines predicting the moon. Through all of it, the metal remains. Physical silver is insurance against a financial system that is showing cracks at every level. It is a bet that reality eventually wins over narrative. And based on everything I have shown you today, reality is reasserting itself. If you are a trader using leverage, I have one piece of advice: reduce your position size immediately, then reduce it again. The volatility we have seen is not over. We have binary events coming: the jobs report, the Trump-China summit, potential escalations in Iran or Taiwan. Any one of these could trigger a 15% move in either direction. If you are leveraged 3-to-1, that 15% move becomes a 45% gain or a 45% loss. One wrong trade and you are wiped out. The market does not care about your thesis. The market does not care about the fundamentals. The market will take your money if you give it the opportunity. Leverage is that opportunity. Trade small, use wide stops, accept that you will miss some of the move in exchange for staying in the game. If you are sitting on cash waiting for a signal to enter, here is what I am watching. I am watching the premiums at the physical dealers. The spot price on your screen is the price of a paper contract traded in New York and London. It is not the price you pay to hold metal in your hand. When those two prices diverge, when the premium over spot expands, it tells you something important. It tells you that the physical market is tight. It tells you that real buyers are competing for real metal. It tells you that the paper price is lying. Right now, call your local bullion dealer. Try to buy a silver eagle or a 1 ounce bar at the spot price. See what they quote you. If the premium is elevated, it means the stress is still in the system. It means the physical market has not caught up to the paper crash. It means smart money is still accumulating. That is your signal, not the spot price on the screen, the premium at the dealer. I have prepared a complete technical breakdown of the support and resistance levels for the coming weeks. It includes the exact price points where I expect buyers to step in, the zones where sellers are likely to defend, and the trigger points that would change my outlook. I cannot go through all the numbers in this video, but if you want the roadmap, the link is in the description below. As we wrap up, I want to leave you with a thought. What we are witnessing in the silver market is not just about silver. It is about the transition from one financial era to another. For 50 years, the Western paper markets determined the price of precious metals. London and New York set the fix, and the rest of the world accepted it. But that era is ending. The physical metal is moving east. The vaults in London are draining. The COMEX registered inventories are at generational lows, and the nations of Asia, China, India, Russia, the BRICS coalition, they are accumulating metal at every opportunity. They understand something that the algorithm traders in Manhattan do not. They understand that real wealth is measured in ounces, not in dollars. They understand that paper promises can be defaulted, but physical metal cannot. They understand that when the music stops, when the paper market finally breaks, the only people left standing will be those who hold the real thing. The $67 crash was not a tragedy. It was a gift. It was a clearance sale, courtesy of the paper manipulators who briefly overwhelmed the physical buyers. But the physical buyers are back. The premiums are elevated. The metal is moving into strong hands, and the price is climbing off the lows. Watch the $90 level, watch the $80 support, watch the triangle pattern that is coiling tighter with each passing day. Something is going to break, and when it does, you want to be positioned correctly. Thank you for watching Mr. Ag. If this analysis helped you understand the current market, hit the subscribe button and the notification bell. Share this video with someone who needs to hear it. Drop a comment below with your thoughts and your location. I read every single comment, and your engagement helps this channel reach more people who are trying to navigate these volatile times. Stay skeptical, stay disciplined, and most importantly, stay safe. I will see you in the next one.